Hello guys, welcome to 3FA3 week 11 lecture. Today's lecture is on options and corporate securities, which is chapter 25 in the Ross textbook that we use. In this chapter, we are going to look deeper into call and put options and that we started to look at in the last week. So we'll be looking at payoffs and profits from a call position holder and a put position holder, both from the long and short position holders point of view. Then we will be looking at different applications of options in corporate finance framework. Today's lecture is also divided in two parts. In the first part, I'll be essentially discussing on how to value call and put options, what factors affect the value of put and call options, and how put and call options are quoted in the market. In the second part of this lecture, we'll be talking about applications like employee stock options and how equity of a company can be viewed as an option as long as the company has a debt outstanding. Then we will be looking at two different financial instruments called warrants and convertible bonds and how the embedded options in them can be valued. We'll also look at other options used in corporate finance. Option features. So we know what an option is. An option is a contract that gives the owner, the holder, the right to buy or sell some underlying asset at a given price on or before a given date, right? So the buyer, also known as the long position holder, has the option, right? They don't have the obligation. They have the option to use the option that they hold, right? The right that they hold. So they will only use it as long as it's profitable for them to use it. Otherwise, they'll just throw away the option. So there are two kinds of options. Call option gives the holder the right to buy an underlying asset at the strike price. And if the long call position holder wants to exercise their option, the writer or the seller of the long or seller of the call will have to oblige. They will have to sell the underlying asset to them. If it's a put option, the holder has the right to sell the underlying asset at the strike price. So put option, long position holder in put option has the right to sell an underlying asset to the short put holder at the strike price. The writer, also known as the short position holder, has to oblige. The writers of the short position holder do not have any option. They have obligations. As I mentioned, option writer is the seller of the option, also known as the short position holder. The price that we are talking about here, the fixed price that we talk about, where exercise of the option will happen, right? The buying price for call option and the selling price for put option, that is called strike price or exercise price, the price at which the holder can buy the underlying asset if it's a call option, or the price at which the holder can sell the underlying asset if the holder has a put option. Premium is the price that the option holder, the long position holder, has to pay to the short position holder to get to buy the option from them. And exercising the option means the act of buying or selling the underlying asset using the option. So the option is exercised only by the long position holder, right? So if the long call holder exercises her option, that means that she is using her right to buy the asset at the strike price. Expiration date, right? Each option has a specific date after which it expires, the last day on which the option can be exercised. There are two different kinds of options based on expiration date and when option can be exercised. In case of American options, the option can be exercised on that date or any date before that date, anytime up to the expiration date. If the option is European option, it can only be exercised on the expiration date. Here I'm showing you guys the option quotations for TD Bank. On the top, we have the share price. This is data from 17th March 2019. So the price of share on that day in the market was 75.57, price of TD shares. And here we have the option quotations. So on the red box, we have options expiring on March 29, 2019. So it's only 12 days after this share price data is gathered, right? So these options in the red box will expire in 12 days time because they expire in March 29. On the other hand, the blue ones, the options that you see in the blue ones, they expire 4 months later, right? July 19, same year. On the left-hand side, we have call options. On the right-hand side, we have put options. Here we have the strike price, right? So for each strike, so let me read you guys what it means. So $72 is the strike price. So if you're talking about the call option, the holder of the call option has the right to buy one share of TD Bank for $72 on or before March 29, 2019, if it's an American option. Similarly, if you look at the right side for put option, the holder of the put option holder has the right to sell a TD Bank share for $72 on or before March 29. That's how we can read this information. We'll talk a little bit more about it in 2 slides. So the pricing terminology for options is very simple. It's very easy to understand. When will the option holder exercise her option? When the option are called to be in the money, when it makes sense to exercise the option. So call option, remember, gives the holder the right to buy. The holder will only exercise her right to buy as long as she can buy it at a price cheaper than what's the underlying asset trading in the market. So if the underlying asset is trading in the market for $50 and the strike price, the right to buy price is $45, in that case, this call option is said to be in the money. Why? Because the call option holder can make money by exercising her option. She can exercise her option and buy the share from the short call holder for $45 and take the share to the market and sell it for $50 because that's the price of the underlying asset in the market at that time. For put option, it's in the money when the reverse scenario happens. Remember, put option gives the holder the right to sell. If the underlying price in the market, if the shares price in the market is $50, right, and the put option holder has the right to sell the share at 60, then the put option holder will exercise the option. Why? Because it's in the money. Why is it in the money? Because essentially the put option holder can now go to the market, buy the share for $50. Remember, that's the price of the underlying asset, and take it to the short put holder and exercise her right to sell the share at $60. So the put option is in the money, exactly, it's mirror image of the call option being in the money. As opposed to options being in the money, options can be out of the money. Again, this is exact opposite scenario of in the money. Out of the money means the option doesn't have any value right now in the market. When does the option not have any value or the intrinsic value? Is when underlying price is lower than the strike price for call options. If the underlying price is $50 and I have the right to buy the share, the strike price is 60, will I be exercising my call option to buy the share? The answer is no. Why? Because if I want to buy the share, I can just go to the market and buy the share for 50 instead of exercising my option. So this is when it's called the call option being out of the money. The options for both call and put option, they're said to be at the money if the strike price and underlying price are at the same level. So you guys can understand whether an option is in the money or out of the money or at the money is determined by the relationship between strike price and the price of the underlying asset in the market, the spot price of the underlying asset in the market on any given day. There are a few things that we can notice. Prices for options that have longer time to mature, that has longer expirations, they're usually higher than options which will mature quickly, which has a shorter maturity time. Call options, as long as they're in the money, call options having the same strike price will be worth more than the put options at the same strike price. Why? Essentially because call options being in the money, they will have more intrinsic value, and put option at those strike prices will be out of the money, as I'll show you guys soon in the next example. So they will be worth less. And the opposite is true as well. Not worthless, they will be worth less. The opposite is true as well. When the put options are in the money, when the strike price is greater than the spot price, then the put option is in the money. In that case, put option will be worth more than the call option at the same strike price. So one more thing about stock option quotations. Trading in option occurs in hundreds, multiples of 100 shares. That means if you buy one option, this gives you exposure to 100 shares of any company. So one option contract costs, how much does it cost? If you buy one option contract, what is the option premium? The ask price that you can see in the quotation times 100, because each option allows you exposure to 100 shares. Similarly, because it allows you exposure to 100 shares, it provides investor an exposure to price change in 100 shares as well. So this is the quotation we showed you guys 2 slides back. So let's go to the 3 important things that we asked you to look here in the previous slide. That prices are higher for options with same strike price but longer expiration. Call options, when they're in the money, is usually priced higher than put options at the same strike price. And put options, when they're in the money, they're usually they will carry a higher price compared to the call option at the same strike price, because the call options will be out of the money. So the color code is red, green, and purple, so that we can follow each one of them. So see the first one. I'm comparing options of different maturities, but with the same strike price, 76, 76, that's the strike price. So we say that options which has longer time to maturity will be worth more. As you can see, they will be worth more for both put and call options. Why? Because longer the time that you have that any option has to mature, the better the probabilities of the option ending up in the money. That is why longer options with longer durations usually is worth more. The second one, the green one, is here. So you guys can see this is the strike price and this is the underlying as spot price today. So call option holder has the right to buy a TD share for $72. Right now, TD Bank shares is selling for $75.57 in the market. That means the call option is in the money. So the call option price in the market is $3.70. That's the call premium that we're talking about. Now think about the put option at the same strike price. Put option gives the holder the right to sell the share at 72 at the strike price. Well, when the stock price, underlying assets price is 75.57, would you be willing to sell the share for $72? The answer is no. That is why you see the price of this put option is really low. So that's what the second condition was, that at the same strike price, if the spot price, underlying assets price, is higher than the strike price, that means if the call option is in the money, it will be worth more than the put option at the same strike price. Why? Because at this strike price, if the call option is in the money, that essentially means that the put option would be out of the money. Exact reverse scenario happens when the put option is actually in the money. Let's have a look. Let's look at this guy now. So you can look at this example or this example. So this has a strike price of 76. So if you're a put option holder, it gives you the right to sell a TD Bank share at $76. Are you happy? Yes. Why? because in the market it's selling for 75.57, but with the put option you can sell it for a higher price. So the put option is in the money, it's worth $3.10. On the other hand, look at the call option holder. Call option holder has the right, or it will give the right to the call option holder to sell the share for 76. The share is selling for only 75.57 in the market. So the call option is out of the money. That's why it will be trading at a price lower than the put option, which is in the money. So this will take a little bit of time to get into your system. But once you guys keep on practicing thinking about it, this will get better with more practice. Now we will shift our gear and look at valuation models for options and looking at the option payoffs. Option valuation is usually done by a model called Black-Scholes formula. You guys will be learning about Black-Scholes model either in your 3FB3 class or in any investment class or in a derivative securities class. Right? In here, we are more basing our information on practices or the uses of options in corporate finance framework. So we are understanding the basic working of valuation of option and the payoffs from option. In that regard, let's assume that these are the notations. So S1 is the stock price, underlying price at expiration, which is one period later. S0 is current price. C1 is the value of call option at expiration, which will also be known as intrinsic value. And C0 is the value of option to date. E is the exercise price of the option. Now, if we look at a call option, and we looked at this payoff structure in the last class as well, what it says is that what can be the value of a call option at the maturity on the expiration date? Well, if the exercise price is $30, right, and the share on the expiration date, underlying asset is selling for 25, the option is essentially worthless. Why? Because we have the right to buy the share for $30, but it's trading in the market for 25. So the option goes out of the money. We let the option expire if we're long call holder. So it can have a value of 0. When will it have a value of 0? If stock price in period 1 is higher than the exercise price. On the other hand, if the stock price is higher, if the exercise price is lower than the stock price on the expiration date, let's say it's $45, that means we will be in business. The option will be, the long call will be in the money. Why? Because we have the right to buy the share at $30. That's our strike price. And we will use this option to buy the share for $30 and take it to the market and sell it for $40 and make money. So what is the value of option on the expiration date? If the option ends up being in the money, this much. That's the value of the option at the expiration date if the option ends up being in the money. Stock price at the expiration date minus the exercise price, right? So what's the maximum profit for a long call holder? Maximum profit is unlimited, right? As the stock price goes up, the payoff of the long call holder goes up with it as well. What's the maximum loss of a long call holder? Maximum loss is the premium that they paid to buy the option from the short call position holder. Now, if you look at short call position holder, their situation is exactly opposite. But remember, they don't have an option, they have obligation. However, they are not worried about their obligation when the strike price is lower than the strike price X is lower than the stock price in the market. Why? Because the long call holder will not come to exercise her option. However, the short call holder is in a difficult situation when the stock prices starts going up in the market. Why? Because as the stock prices go up in the market, the long call holder coming and exercising the option, right, to buy the share for $30 from the short call holder is increasing. right? The higher the stock price, the bigger the loss the short call position holder can suffer, right? What's there? The highest amount of loss that a short call position holder can suffer? Unlimited. Just like the profit of long call holder was unlimited. What's the maximum benefit of a short call holder? Well, the maximum benefit is the price that they got by selling the call option to the long call holder, the premium that they received. So that's the maximum profit that short call holders can make, and the maximum loss that they can make is unlimited. The same story can also be replicated for long put and short put holders. Remember, in put options, it's different from the call options because it gives the long put holder the right to sell the share at a certain price, at the exercise price. So if the share price in the market is higher, right, on the expiration date, let's say it's $50, and you are a long put holder where you have the right to sell the share for 30, would you be selling your share for 30 if you can sell the share for $50 in the spot market? The answer is no. In that case, on the expiration date, the intrinsic value of the put option is zero. When will the put option holder be happy? When will they be in the money? Well, when the spot price of the shares in the market is less than the exercise price of $30, then the put option will be in the money. How much? Let's say the price is $15 in the market. That means essentially the long put holder can go to the spot market, buy the share for $15, bring the share back to the short put holder and sell it to them for the exercise price of $30 and make $15. So the intrinsic value of a long put or the put holder is this. If the option ends up being in the money, the difference between the exercise price and the spot stock price on that day, on the expiration day, that's the intrinsic value of the put option. So what the maximum loss of the put option holder? The maximum loss is if the put option ends up being out of the money, then the price that they paid to buy the put option from the short put holder, that's the maximum loss. What's the maximum benefit of the put holder? So the maximum benefit keeps on increasing as the share price keeps on going down in the market. I keep on saying share price, it can be any underlying asset. Okay, if the price of the underlying asset keeps on going down in the market, the profit of the long put position holder keeps on increasing with it as well. The short put position holder's position is exactly opposite, right? When the prices of the underlying asset is high in the market, they are not bothered. Why? Because the long put holder is not going to exercise his options. But the long put holder will exercise his options as soon as the put option is in the money. So when the prices drop enough, then the long put holder will exercise their option, and that will be a case of loss for the short put position holder. So guys, please understand this. So there are 4 different positions that we are talking about here. We're talking about long call position holder, this guy. Who do the long call holder buy their call option from? They buy it from the short call position holder, this guy. These are the 2 positions for call options. One is long call, the other one is short call. Then we are talking about 2 positions for put positions as well, right? Long put and short put. These are the 2 counterparties in a put option. Right? So we need to know the payoff profiles for all 4 parties in here, right? Long call, short call, long put, and short put. Now, what would be the call option price? Can we give it a boundary? The answer to that is yes. First of all, the call option cannot be selling for a price higher than the underlying asset itself, right? I cannot have the right. Let's say that my stock is selling for $50 in the market. The option that gives me the right to buy the share from your short call holder cannot be more than $50. So that's the first condition. That's the upper bound. The lower bound, it shouldn't be zero, first of all, because it should have some value because it's being sold by somebody. and being bought by somebody, right? The call option is being bought by somebody. There must be a premium. So it cannot be zero. It has to be worth something when we talk about lower bound. But how low can it go? The lowest it can be is the intrinsic value at any point in time. What is the intrinsic value at any point in time? The difference between, so we are talking about call option, okay? The difference between stock price right now and the exercise price, that is the intrinsic value of the option. So what we are saying here essentially is that the upper bound of a call option would be the highest it can be is the stock price. And the lower bound should be the difference between the profit that the long call holder would make if they exercise the option right now. The stock price minus the exercise price. Now, what happens if this condition is not held? Right? What happens if these bounds are violated? If these bounds are violated, then there would be arbitrary profit to be made. Arbitrage opportunities will exist. Let me show you guys an example real quick. Suppose call option is selling for $4 and the stock price in the market is $10. And with this call option, it gives you the right to exercise the call option at $5. That means you have to pay the short call holder $5 to buy one share. So if these three numbers are true, then this condition of the lower bound is violated, right? Because C0, right? So which is $4, it's supposed to be, right? It's supposed to be more than the intrinsic value, stock price minus the exercise price. But here, this is 4, and the right-hand side becomes 5. Right, so this condition is violated, the lower bound condition is violated. Let's see how it doesn't work, how we have arbitrage opportunity in this case. What can you do as an investor? You can buy this call option for $4. And with this option, you can go to the short call holder and give him $5 to buy one share of the company. So what's your total cost? $9. What can you do? This $9 that you use to buy the shares, you can take the shares to the market and sell it for $10. How long will you be doing it for? Forever, because it's easy $1 right there. Now, if you keep on doing it, what will happen? The price of the call option will start to increase. Why? Because of the buying pressure of the call option. And at the same time, the price of shares in the market will keep on getting down. Why? Because of the selling pressure, all the selling that you are doing in the market, you and other arbitrage profiteers will be doing. So this condition will not hold for too long. That's why we are saying that this upper and lower bound has to be uh, present for any call option market or put option market for that matter to work properly or efficiently. So we have the upper bound of the call option and we have the lower bound of the call option. This is called intrinsic value. What will you get if you sell, if you exercise your option right now, right? You will have to pay the exercise price. With the exercise price, you can get the share and you can sell the share in the market for S0. So that's your profit as long as the option is in the money. However, this picture shows us, okay, so we know the call option payoff looks like this. In the market, when you see the option prices, the call option prices are actually floating above, a little bit above this exact value. Why? Essentially because with time, because the option has time to maturity, that means even if the option is out of the money here, even if it is out of the money in here, right? That means that doesn't mean that the option will end up being out of the money. Why? Because there is still time for the stock prices to change in the market. And if the stock price in the market changes, then the option may become in the money. In here, it's in the money, but the call option holder can even make more money with the time given and the share price, the possibility of share price going even higher. So this is what we see. The typical option values lie somewhere a little bit above, floats above the exact option payoff that we have shown you, the straight line that we have shown you. There are quite a few factors which determine how far away from the straight lines will this curve lie, will this actual option values lie. As we get closer to the expiration date, the actual value of option will get closer and closer to the straight line that we see, the option payoff that we showed you. Now there are 5 determinants of call and put options. We'll talk about call options and we will just go over put option values really quickly, because it will, after we do call options, it will be simple to see. Now, if the option is certain to be in the money, if you know if it's guaranteed, and it won't be, but if it is guaranteed to be in the money, then the call option value can be calculated based on this. We know that we'll be exercising the option. So, and the exercise will happen at a later date. So this would be the present value of the exercise price. And what is the value of the stock today? Not in S1, but these are the things that we know, right? We know the stock price in the market right now. We also know the exercise price, and we also know that the exercise can happen any day up to the expiration date. So this is our payment when we're exercising the call option, and this is the price that once we use or exercise our option and buy the share, this is the price that we can get to if we sell the share in the market after exercising the call option to buy the share. Now, looking at this, some of them are very simple. Stock price, as the S0 increases, the call price increases with it, of course, right? Because the call option becomes more and more in the money, and with S0, C0 will increase as well. So S0 increase, stock price increase means that the call price will also increase. If you can get an exercise price higher or lower, actually we want the exercise price to be lower because we're investing in call option, right? However, if exercise price is higher, that means you will end up having to pay more, right? Because that's the price at which you will exercise your option. You'll have to pay to your short call holder. Higher the exercise price means that your call option will be what? Less. Time to expiration, T here. The longer the time to expiration, this is usual logic, the longer the time to expiration, the longer the duration of the contract, the higher the value of the call will be. This will be same for put option as well. The higher the RF, risk-free rate, the call price increases with it. Why? Because remember, we are paying it, right? So if you increase the RF, that means you're discounting the exercise price by a bigger number. So that will increase your value of your call, because this whole thing will go down, right, as the RF goes up. So these are the 4 determinants of call value if the option is certain to be in the money. Now we know that we don't know about the future, right? We cannot guarantee the future. So what happens if the option may end up being out of the money? Then there is one more variable in here, one more determinant in there. That is the volatility of the return of the underlying asset. How volatile is your underlying asset, the stock that we're talking about, the stock on which we have been buying the call option. The more volatile it is, the more volatile means the more sigma it has, the higher the value of the call option. Why? Because the more volatile it is, that would lead to the option ending up in the money. The chances of the option ending up in the money would be higher. You can say, Walker, but the option ending up out of the money will also be higher. Yes, but if the option ends up out of the money, it really doesn't matter how far deep it is ending up out of the money. If we lose $2, it's the same as losing $6 when we are exercising option. Why? Because as long as the option is out of the money, we are not going to use the option anyway. The same logic, the same factors, the determinants can be used to find the determinants of a put option. Right? Remember, these are the 4 determinants when the put option is guaranteed to be in the money. The situation is a bit different here. Why? Because here you would be paying. Essentially, what is happening here? You'd be selling your underlying asset, right? So the exercise price is something that the long put holder will be receiving. When will they receive it? One period later. So this is the present value of the cash inflow. And this is the outflow, right? So they would have to buy the share from the market and then sell this share to the short put holder. So that's why you can see compared to the call option, the put option value, the intrinsic value of put option is just reverse, right? But the same logic still holds, right? All these 5 factors that we saw in the call option is still working for the put option as well. Remember, we are looking at the value of call and put from the long call and long put holders point of view. So if we bring all of this together, we have this, the 5 factors that determine option values and how these factors affect value of call and value of put. This is nothing but, bringing those previous 2 slides together. So that ends our first section. We've looked at how valuation of option happens theoretically. We've looked at how to read option quotations, and we have known that options uh, are written on multiples of 100 shares. And we have also looked at 5 different factors affecting an option value, whether it's a call option or a put option. Remember, when we learned to value the option, we looked at options, 2 different kinds of option, call and put, from both long and short position holders point of view. In the second part, we'll be talking about the applications of options in corporate finance. We'll be looking at employee stock option plans, and we'll also be looking at warrants and convertible bonds and equity that can be used as an option in a levered fund. I welcome you guys to listen to that segment as well.